Warren Buffett is often regarded as one of the most exceptional investors in history, possibly the most outstanding. While not everyone may agree with that assessment or align with his investment philosophy, the outcomes of his approach speak volumes. Back in 2008, he overtook Bill Gates to become the world's richest person, according to Forbes. Although he has since dropped to the 5th spot on that list, his overall net worth has more than doubled since then. In 2024, his company, Berkshire Hathaway, reached a remarkable milestone. It became the 7th publicly traded company to hit a $1 trillion market valuation. What makes this feat particularly noteworthy is that it was the first non-tech company to do so. Berkshire Hathaway has built a reputation for its uncanny ability to identify profitable investment opportunities. Buffett himself acknowledges that not every venture has been successful, but when looking at the long term, the company has achieved an astronomical return, reportedly over 5.5 million% over 6 decades, eclipsing the performance of major benchmarks like the S&P 500. In the early years of his investing career, Buffett followed what's commonly referred to as the cigar butt strategy. The concept revolves around purchasing struggling companies at a steep discount and selling them once their value shows even the slightest recovery. He once likened this tactic to picking up a discarded cigar with one puff left. It might not offer much, but whatever value it still has is pure profit. However, this short-term and opportunistic approach evolved significantly in the 1960s, largely due to the influence of Charlie Munger, who would become Buffett's long-standing business partner and close confidant. Munger advocated for a more long-term, quality-driven philosophy known as value investing. Under this model, Berkshire Hathaway shifted focus toward acquiring well-established companies with recognizable, time-tested brands, some of which date back to the 19th century. Today, at the age of 94, Warren Buffett's long career has granted him a rare first-hand perspective on the evolution of American business. His deep familiarity with these legacy companies, many of which he has observed for decades, gives him a distinct edge in evaluating their potential. One key element he looks for in an investment is a trustworthy and capable leadership team. Berkshire Hathaway is known for taking a hands-off approach when it comes to management, allowing companies to operate autonomously after acquisition. Buffett is also known for maintaining substantial cash reserves. This enables Berkshire Hathaway to move quickly when opportunities arise, typically during market downturns when valuable assets are available at discounted prices. One of his most quoted philosophies is, "It's better to buy a great company at a fair price than a fair company at a great price." It might require a moment to fully digest that logic, but it captures the essence of how he thinks about investing. A reflection of this philosophy is seen in the way Berkshire Hathaway handles its own stock. The company discourages short-term trading by refusing to split its shares. Most companies perform stock splits when share prices climb too high, making the individual shares more affordable and increasing trading activity. In contrast, Berkshire Hathaway's Class A shares have become notoriously expensive, surpassing $100,000 in 2006 and trading above $700,000 today. Additionally, the company hasn't issued dividends since 1967, preferring instead to reinvest profits to generate greater long-term returns for shareholders. Considering its expansive history, it would be impossible to detail every investment Berkshire Hathaway has made. The company has bought and sold stakes in hundreds of businesses over the past 60 years. To simplify things, I've selected 12 acquisitions that I believe are either the most iconic, the most influential, or the best illustrations of the firm's wide-ranging interests. Berkshire Hathaway's origins date back to 1955, when two struggling textile manufacturers, Berkshire Fine Spinning and Hathaway Manufacturing, merged. Despite the combined size of the company, it faced a bleak outlook. The New England textile industry was in decline, and the new entity was rapidly downsizing. Over the next 10 years, its value dropped significantly, presenting Buffett and his investment group with an opportunity to acquire enough shares to take control at a discounted price. have become notoriously expensive, surpassing $100,000 in 2006 and trading above $700,000 today. Additionally, the company hasn't issued dividends since 1967, preferring instead to reinvest profits to generate greater long-term returns for shareholders. Considering its expansive history, it would be impossible to detail every investment Berkshire Hathaway has made. The company has bought and sold stakes in hundreds of businesses over the past 60 years. To simplify things, I've selected 12 acquisitions that I believe are either the most iconic, the most influential, or the best illustrations of the firm's wide-ranging interests. Berkshire Hathaway's origins date back to 1955, when two struggling textile manufacturers, Berkshire Fine Spinning and Hathaway Manufacturing, merged. Despite the combined size of the company, it faced a bleak outlook. The New England textile industry was in decline, and the new entity was rapidly downsizing. Over the next 10 years, its value dropped significantly, presenting Buffett and his investment group with an opportunity to acquire enough shares to take control at a discounted price. That sets the stage for the first major acquisition on this list: National Indemnity Company, an insurance firm based in Omaha, Nebraska, Buffett's hometown. Acquired for $8.6 million, this purchase marked Berkshire's initial entry into the insurance business, which would go on to become the backbone of its investment empire. Insurance companies deal with what's known as float, money collected from policyholders as premiums that hasn't yet been paid out as claims. This float essentially provides capital that can be invested elsewhere. At the time of the National Indemnity acquisition, Berkshire's float was around $16 million. Today, it has grown to approximately $171 billion. Next on the list is See's Candies, acquired in 1972. This was a turning point for Buffett and Munger, showcasing the value of acquiring high-quality companies at reasonable prices. Founded 50 years earlier by the See family, the brand had earned a reputation for making premium chocolates. Buffett often credits this deal with helping him fully embrace the long-term value investing strategy. The company was purchased for around $25 million and, as of today, has been under Berkshire's ownership for a longer period than it was owned by the founding family. In 1985, Berkshire made a significantly larger acquisition. Scott & Fetzer, purchased for roughly $320 million. While the name might not be widely recognized, Scott & Fetzer owned brands such as Kirby vacuum cleaners and World Book encyclopedias. Buffett saw value in World Book partly due to personal experience. He had used the encyclopedias as a child, and his grandchildren were also fans. Unfortunately, the internet's rise in the 1990s severely impacted encyclopedia sales, and this particular investment struggled in later years. In 1995, Berkshire Hathaway bought Helzberg Diamonds, a jewelry retailer with 146 stores across 23 states. This purchase might not stand out as a headline acquisition, but it underscores the diversity of the company's portfolio. The chain had been around for 80 years and had built a solid reputation in the jewelry market. It also marked a shift in strategy as Berkshire began acquiring entire companies rather than just minority stakes. That same year, the company finalized one of its most impactful deals, acquiring full ownership of Geico. Although Berkshire had held a substantial stake in Geico since the 1970s, it wasn't until 1995 that they purchased the remaining 49% for over $2 billion. Buffett has a long-standing connection to Geico, going back to 1951 when, at just 20 years old, he invested half his net worth in the company. In 1997, Berkshire acquired Dairy Queen, the nation's largest ice cream restaurant franchisor, with more than 5,700 locations at the time. Buffett had been a long-time customer, and the $585 million acquisition continued the trend of acquiring recognizable, family-friendly brands. By the turn of the millennium, Berkshire Hathaway was engaging in even larger acquisitions. In 2000, the company bought Benjamin Moore, a historic paint brand founded in the 1800s, for $1 billion. 2 years later, they added Fruit of the Loom to their portfolio. The iconic underwear and clothing brand was emerging from bankruptcy and had lost a significant portion of its value. Nevertheless, Buffett had confidence in its leadership and paid $835 million to acquire the company outright. It remains part of the Berkshire empire today. In 2009, Berkshire Hathaway completed its biggest acquisition up to that point, Burlington Northern Santa Fe, BNSF, the largest freight railroad operator in the U.S., for $34 billion. The deal included a 31% premium and was seen as a strong vote of confidence in the long-term resilience of the U.S. economy, particularly the role of railroads in freight transport. In 2013, Berkshire teamed up with private equity firm 3G Capital to purchase H.J. Heinz Company in a deal valued at $23 billion. This acquisition went beyond ketchup and included a wide array of food products. A couple of years later, Heinz merged with Kraft Foods, forming the Kraft Heinz Company. While it was initially heralded as a mega merger, its performance has been somewhat underwhelming compared to other Berkshire ventures. In 2014, the company took control of Duracell, the battery manufacturer. This acquisition came through a complex swap. Berkshire had long held a stake in Gillette, and when Procter & Gamble acquired Gillette in 2005, Berkshire received shares of P&G in return. Nearly a decade later, they traded those P&G shares back in exchange for full ownership of Duracell. Finally, in 2015, Berkshire acquired Precision Cast Parts, a manufacturer of industrial components such as fasteners and pipes. The $37 billion deal became Berkshire Hathaway's largest acquisition to date and further diversified its holdings in the industrial sector. Beyond these headline acquisitions, Berkshire Hathaway has poured billions into insurance, utilities, and media companies. It has also played a role in major corporate mergers, including Disney's purchase of ABC in 1995 and Mars' acquisition of Wrigley in 2008. In addition, the firm holds, or has held, substantial minority stakes in major corporations such as Coca-Cola since 1989, American Express since 1991, Goldman Sachs 2008, and Apple 2016. The investment in Apple in particular has proven to be one of Berkshire's most profitable. With such a massive portfolio, it's nearly impossible to catalog every deal and partnership. But if you believe there are other investments or acquisitions worth highlighting, feel free to point them out. The motivation for discussing all of this now stems from a recent announcement by Warren Buffett. At 94 years old, he plans to step down as CEO of Berkshire Hathaway, though he will remain chairman. This comes just 2 years after the death of Charlie Munger at age 99. For the first time in decades, the company will no longer be led by the two individuals most responsible for shaping its philosophy and success. Naturally, this raises questions about the future. Will Buffett's successor, Greg Abel, along with the rest of the leadership team, be able to carry on the company's legacy and meet the high expectations set by its founders? That remains to be seen. What do you think lies ahead for Berkshire Hathaway? Has the company's success been driven more by skill or by good fortune? Feel free to share your thoughts about its investment strategy or any of the companies mentioned here.